Hi everyone. This video is a question and answer session for my Patreon members and all of you out there on YouTube. My patrons are going to ask questions and I'm going to attempt to provide answers for them. I've been investing since 1996, the last 10 years or so, specializing in technical analysis and swing trading, along with some occasional long-term holds. This, however, is not investment advice. It's just for education and information and perhaps some entertainment. And if you want me to try to answer your question, consider signing up for my Patreon. It's only $10 a month. All right, let's get to the questions. So the first question is from one of my new Patreon. So the first question is from one of my new Patreon members, Matt, who said, could you go over how you find stocks for your focus list versus on deck, and when do you promote from on deck to focus? So first, let me define my focus list is stocks that are eminently buyable. Is that the right word? Eminently? Very close to being buyable. They'd be viable within a day or two, up to a week max, assuming that they develop constructively and stay tight and break out and so forth. Conversely, the on-deck list is stocks that are in uptrends, assuming I'm long the market, which I certainly am right now in this new bull market, but that just have issues. They're overextended. They are still working up the right side of a base, but haven't provided a nice tight area to cheat, so to speak. They're too wide and loose, or bucking Broncos. They're too low priced, which makes them wide and loose bucking Broncos. So then I go over these lists every day, and I move them back and forth from focus to on deck, back to focus again, and then occasionally, if they have a big gap down on earnings or something, or they roll over, then they eventually drop off the list. But they're very fluid lists, and I look at them every day. As far as promoting them, so I guess obviously when they tighten up, when they make a tradable pivot where I can get put a tight stop beneath a handful of tight action days. If they're rounding out a base, maybe the base is complete and it's got a nice handle set up and it really should just go. Let me show you an example of an on-deck stock versus a focus list stock. So here's Uber. This is an on-deck stock. Obviously really nice uptrend, but if you look at it, let's just draw a few lines here. Here's probably the last, here's really the last actionable base. Hold on a second. Should have been prepared for this. Okay, so here is Uber's base, right? You've got your cup. You've got a little bit of a handle that formed here. You could have bought it right there. Broke out, squatted, came back in pretty hard, and eventually got support on the 200-day moving average right here. So this would be our buy point right here. And then as you can see, it went on to make a high handle. So this would be a good secondary buy point. But even if we draw in the secondary buy point, if we measure from the secondary buy point, it's 25% off of that point. So it's too far extended. So we need to wait now for it to come back in at least close to the 50-day, or preferably make a new base of a month or two. So this will be on deck, and then if it starts coming in on lower volume, we want big volume moving up, low volume coming down. If it comes in near the 50-day, then I will start getting considering it for a focus list. In contrast, here's one I have on focus list right now, KNF, Knife River Corporation, construction materials, gravel, that sort of thing. It's got really a nice long, tight area of trading, and it's got a little bit of supply that is trying to break through. So when it pushes through here strongly, that would be an area where we could put on probably half a position. So essentially what we'd be doing is cheating on its first primary base. This is a recent IPO. This is really too small to be a primary base. A lot of times a stock will IPO and run up and then set up a primary base. So this stock is good to go. And in fact, if it moved back above, say 45.4 or so today, I would be comfortable taking a stab at it and putting a stop, probably actually right beneath today's low right here. Or alternative, you could do a staggered stop, half right here and half right here at say 42.3 or so. Now, as far as where I get my, how I find my stocks for my focus list and on deck list, starts with this guy right here, a Minervini Private Access, who every morning he puts stocks on his focus list. This is his live stream here. If we go down, you see this morning, 30 minutes after the open, he put these stocks on his focus list. So I go through these and kind of call some of them out. Some of the I eliminate some of the wilder biotechs, or like today, NGL. This is a great looking chart that broke out, but it's a limited partnership and you have to do some additional tax forms and stuff like that. So I eliminate some of those. Then the other thing is, I only put out my videos on the weekend. So what makes his focus list on Monday, by Friday, some of these will either be many of them will be overextended because they've worked successfully, and then they'd be candidates for my on deck list, or perhaps the chart has begun to fall apart and then they don't make my focus. So about half of my stocks that make it on the focus list and on deck are from Mark Minervini's MPA. Then I also run MarketSmith screens as often as I can, at least once a week. I look at the code 33 scan screen. This is stocks with 3 consecutive increases in sales, earnings, and profit margins. Super micro SMCI is a great example of one of those that has worked well. And I look at I have a relative strength screen that just shows the stocks that are making new yearly highs in relative strength. And I also look at the Mark Minervini screens that he has on MarketSmith. And to find these, you go, and I've done videos on this stuff in more depth that you can search for on my channel if you want to. But you go to find the Minervini screens on MarketSmith, you go reports, you go stocks, you go technical, it's a lot of layers. And here you go, the Minervini 1 month trend, that will find you some power plays. And then I also like to look at the Minervini 5 months wide trend template. MarketSmith is a paid, you have to subscribe to it. It's fairly expensive, and MPA is really expensive. So keep that in mind. But yeah, so I get them from there. And then also I use stockcharts.com. Let me show you. Okay, so I've been a member of stockcharts.com for quite a while now. And I've got all of these lists here. Everything from my current portfolio to prospects to industry groups like gold, defense stocks, mining stocks, bank stocks. So one way, when I catch wind of an industry that's heating up, let's say that, I don't know, the gambling stocks are heating up, then I can click on those and then I can just start screening them. Like, look at that ACEL. Here you've got a nice cup, beginning of a handle. So I could throw that on deck right now. Boyd Gaming's got a nice little trend channel, right? Upper trend line there, lower trend line there. It's at the lower trend line. We could arguably put that on focus. So Churchill Downs, meanwhile, falling apart. I probably should just drop that one altogether. So I use my industry groups on stock charts. And then I also have this list. I just call it prospects. Got 900 and some stocks on here that I've been watching for years, some of them for decades. I just know them really well, And I will just, when I have time, screen them. I'll click on percentage trade, percentage gain, and I'll just see what's breaking out. SoFi, as you probably know, is up 20%. Nickel is up 19%. Or I'll look at which stocks are moving on big volume and do that kind of thing and keep an eye on stocks for you guys. And I suppose the last other areas would be, I have just a handful of people I subscribe to on Twitter. Some of them are my Patreon members, and then like 𝗕𝙗𝐻𝗵𝐵, who's a U.S. investing champion. And of course Mark Minervini and Mark Ritchie, who are on MP. I watch them for stock ideas. Let's move to the next question. Sorry, that was kind of a long response. Yeah, Matt had one other question. He said, "Holy moly, what in the world kind of pattern do you call this URGN? That is some kind of Green Day." And he was pointing out this huge breakout from a few days ago. So this has the makings of a power play. Mark Minervini talks about this. I can't remember if it was just in the second book or in both of his trading books. But basically, you have months of dead price activity, sideways price activity. You really don't want a downtrend or a prior uptrend. You want sideways action for as long as possible. Then you want a huge move of 100% or more in less than 2 months. This goes from 9 to 23 in a couple days, so that fits the bill. And then and that is what's known as the flag pull of the power play. And then you want it to make a flag. You want it to come back less than 25%. So that would be right there. Here's your flag pull, 180%. And you want it to build out this flag for 10 to 20 days is the sweet spot. You want it to be really as tight as possible. You want it to make a flag, something like that. And then you buy the breakout of the flag. If you want to get really creative, you can try to buy it when it bounces off the lower trend line of the flag. Definitely higher, less likelihood for success when you do that, but then you get in at a better price point. Let me show you an example here. Okay, so here's a power play that I'm in right now, WEAV. You've got months, Weave Communications. You've got months of dead price action. You've got a flag pull of about 100%. This is 96%. Didn't quite make it, but this is an art, not an exact science. And then you have a tight flag. The tighter, the better. You don't want people, the tighter it is, the more it indicates that investors are holding on to their shares, not willing to give them up for that 100% gain. And then, like I said, traditionally you buy the breakout when it breaks out the top of the flag between 10 to 20 days. Once you get past 20 days, then it's probably going to start forming a more traditional base. Alternatively, if you want to try to buy a bounce off the bottom of this trend line, you can, but then you're going to want to put not only a stop on it in terms of price, but a time stop. You might say, okay, I'm buying it here, and if it doesn't break out within a week, I'm going to let it go. But yeah, you buy here, and then ideally it works out like this. Breaks out. This one broke out for about 45%, and now it's setting up a nice tight new pivot point to buy from, and I actually added some right there. Okay, Ricky says, I would like to understand VCPs better. Let me define it for you, Ricky, and then I'll give you a few great examples. In fact, let's look at Netflix while we're talking about this. So the VCP stands for Volatility Contraction Pattern. This is Mark Minervini's, two-time U.S. investment champion, Mark Minervini's kind of bread and butter concept. He compares it to the wringing out of a towel. You have a towel that's wet, and you squeeze it the first time, lots of water comes out. Squeeze it the second time, medium amount. Squeeze it the third time, a small amount. Eventually, there's no more water that can be wrung out. And that is a metaphor for the act of wringing out short-term sellers from a stock in a consolidation. So ideally you want to have a prior uptrend, and then you want to see the waves of the price action get smaller and smaller. So here we see Netflix, here's your prior uptrend, and then we see a large wave of volatility as it comes in, then a medium wave, and then a smaller wave. So each time it comes back in, fewer and fewer sellers, the less amount of supply is coming to market. Sorry, I'm not being very articulate today. So eventually all of the short-term holders have been wrung out, and then the stock has will go up significantly with just a handful of buyers. And so in this instance, I bought it right here, and so far so good. Let's look at another example. This is on a bigger scale. Costco, we have this symmetrical triangle that also has volatility contraction characteristics. You can also look at it as the coiling of a spring. See, this spring is just getting tighter and tighter and tighter, and this took place over a year and a half. VCPs can take place over months or years, or over days, or even if you are day trading, which I do not do, within a matter of minutes. We can even mark this up for you real quick. So look, here's our volatility contraction. Large, medium, medium, smaller, smaller, and away it goes, right? And here's the 1-year chart of Costco showing my purchases. Now here's Weave again. We looked at it in terms of a power play. We can also look at the volatility contraction on a much smaller scale than Costco. So here is this high tight base, if you will, high tight flag. And if we look at the volatility, if we look at the volatility contraction, we've got a little contraction there, and we've got a little contraction there, we've got a little contraction there. See how it's just getting tighter, tighter? So then you buy when it breaks out of, this is called a pivot area. You buy when it breaks out of the pivot area, and if it's going to behave normally, it should just go, and it really shouldn't get cut beneath this pivot area. So you could set a tight stop at 1049 or so. So far, so good. Here's one last one, AI. I'm watching this one carefully. It's tightening up pretty nicely, and obviously it is poised to play a role in the AI movement with a name like AI. So if we look at the volatility in this latest, I guess we can call this a congestion zone, consolidation area. Here you've got a large wave of volatility, and then it's just getting smaller, and it's just starting to tighten up. Now, we saw the opposite a few days ago. It had this bearish engulfing day and widened out. That's not what we want to see. We want to see it get tighter and tighter and tighter. So let's keep an eye on it. This one is on my focus list now. I could show you countless examples of VCPs, but you probably get the point. Let's see, Kevin asks, CCL, should we wait for the 50-day to catch up? So CCL is Carnival Corporation, and in hindsight, it was just a matter of time that these started going up again, because they just got destroyed by COVID and then the subsequent crash of 2022. So it makes sense that eventually these different cruise lines will get back up somewhere near their equilibrium point, which for CCL would maybe be around 50 or so. But that's looking at it from a value investing perspective, and I don't really do that, because you might wait months, you might wait years for the value of the stock to come back to where it should be. I like to trade momentum. But getting back to your question, I think you could do a combination here. Certainly, this is what's known as an early turn. Minervini did a study, 98% of the biggest moves occurred after a stock was in a stage 2 uptrend for at least 4 months. And here we can define an uptrend as it being above its 200-day. And so it's only been above its 200-day for about 3 months. So we're still a little early on this one. This is the 50-day. Certainly it's extended above it. We do have the 200-day firmly pointing up and the 50-day firmly pointing up. So personally, with a stock like this, I probably would do a combination where I would put on a third or a half of my position. And if I was on the ball, I probably would have bought this little gap. I normally don't buy gap ups, but this is just a little tiny gap. Yeah, 2%. So I probably would have put on a half or a third right here with the idea that this thing is probably going to build out. What we want to see it do is make some of this volatility contraction that we've been talking about, right? Where so it continues to contract and contract and contract. The 50-day starts catching up, and then when it gets closer to the 50-day, then when it breaks out, then I would add the rest of my position. If you wanted to play it safer, more conservative, you could wait for that to occur. Now the weakness with that is maybe it just goes, and then you don't have any position on. But I think if you're really high on the stock fundamentally, you can rush the gun a little bit and put on a position, because this is a tradable area. It's only about 8%. So you could buy, and you could even buy it today and put your stop right here at about 17, and you'd only have a stop of about 7%. Now, you have a little bit of immediate supply here, so probably it's going to stall out, if it's not stalling out already, somewhere between 19 and 19.5. Okay, here's a question from Lee Ann here. And now that I think about it, I think she told me her name was Lay Ann. Lay rhymes with hey, if I'm right. You can correct me if I'm wrong. Welcome back. I was on vacation. Let's see. BHV tanked after hours. If the goal is to have only... So, in a strong bull market, I want to be really concentrated. I want to have 5 to 10 big positions, because, that's how you make the real money. A 50% gain on $500 is $50, right? But a 50% gain on $10,000 is $5,000. So when the odds are in your favor in a rip-roaring bull market, I want to be really concentrated. So she says, if the goal is to have only 5 positions, is it better to not include a biotech? Because biotechs are so wild. Biotechs, probably more than any other stock, except I suppose penny stocks in general, are very susceptible to gap ups and gap downs as they gain FDA approval or do not gain FDA approval on different drugs and so forth. And so here we can look at the good and the bad. Here's BBIO that went up 90% in 2 days on good news about one of its drugs. Conversely, as she talked about, here's BHVN that popped down negative 30% in a day when the FDA refused to move forward on approving one of their drugs. So do we want to have a biotech in our small concentrated portfolio? It just really depends on your appetite for risk. Personally, I enjoy playing the biotechs, and I've been pretty successful with them over the years. But there's a few different things. One, you got to really pay attention to the drugs in their pipeline and when results are coming out and so forth. 2, I always play them with much smaller positions, and then I can always add to that position if the stock begins to pan out. And then 3, just taking... I'm very, very quick to take profits on the way up with biotechs, much more so than other stocks. Now, there's kind of a hybrid, if you will. If the pre-revenue biotechs are too wild for you and are causing you to not sleep well at night, you can buy medical product companies which make products for the medical field, which are quite a bit more stable and can still be quite lucrative. Two examples of medical products: Intuitive Surgical, which is a medical robotics company, and as you can see up and to the right, and Inspire Medical Systems, which has a CPAP machine alternative. That would be one way to play it. To answer your question, it really depends on your appetite for risk. The biotechs are inherently high risk, high reward, smaller positions if you decide to play them. Let's see, David Taylor, welcome back. If any of these are of interest, I'd appreciate a comment. Let's just glance at them really quick. I just opened up some charts of them in stockcharts.com. So let's see, the first one is Modine Manufacturing. This looks like a great stock to be in. Your base is right. So it's really kind of a funky base that didn't give you much of a right side. You've got compression. See how the left side is very gradual and you've got some oscillations. The right side is very compressed. These have a lower success rate. Minervini generally does not play them. In this case, obviously this one worked, but we have to control risk in real time, not in hindsight. So hopefully this was probably earnings on this little gap up. If you played this gap up, you nailed it. And now it's making its first real consolidation, its first real natural reaction, if you will. And we do see some volatility contraction. Like here's a contraction, here's a smaller contraction, another little gap up. So you certainly could have played it, buy it right here, set a stop right here. And guess what? If you really like this stock fundamentally, you could do the same thing here. I would put on a smaller position, like a third or half or even a quarter, because you've got some immediate supply. But you could buy right here today, put your stop right here. Certainly your odds for success are getting a little bit lower because it's pretty extended above the 50-day, and eventually it's going to come back and find the 50-day. And let's look it up. My partner is Seeking Alpha Premium, and the place that I do the majority of my fundamental analysis is on Seeking Alpha. And if we look it up, let's just glance at it real quickly. So Seeking Alpha provides thousands of articles by analysts on these companies, in addition to fundamental information, which can be found under these tabs. So when you find a strong stock like this, you don't know anything about it, this is a great way to learn about the company. You can find news articles about it, and you can take a look at what the analysts have to say. Modine Manufacturing stock is still a solid bet on EV future. Okay, I don't know anything about the stock, but apparently it's in the electric vehicle space, and you can read the bullet points. The way I see it, Modine appears to be a cash machine. That sounds good. So if I was interested in the stock, then I could read some of these articles and get a feel for the fundamental picture instead of just trading on the technicals. And when I'm putting on a big position, I really want to know both. If you're interested in Seeking Alpha Premium, there's a link in the description of this video. And here's another stock you wanted to look at, ARLO. Nice stair-step action. We really want to see stair steps. We want to see, as the stock is going up, pressure is building, and we want to see periodic release of pressure. When that doesn't happen, when a stock just goes straight up, you know what happens. It takes the elevator straight down again. And here you got yourself a cup. You got a handle. You could buy right here. Look at this volatility contraction. You've probably seen that everywhere now. And you've got kind of a base on base here. You could have bought it right here. Here's another base and another base. Now, with each, it's kind of like the game of Jenga. With each base, the odds of success get a little bit lower, but stocks can stay in an uptrend for a year and a half or so. This stock, 1, 2, 3, it's only been in an uptrend for about 3 months. So really, you could argue it's just getting started. Looking at the 10-year chart, it's cleared most of the supply. One thing I really don't like about it is it's under $12. Stocks under $12 have less institutional support and tend to make dramatic moves to the downside sometime. This one, however, the price action is really pretty tight. Just looking at it on MarketSmith. Provides security cameras, security software. That's certainly a good niche. It's going from losing money to making a fair amount of money. Earnings coming up in 10 days. So I absolutely, if you're in this stock, that's awesome. As far as buying it, certainly you can play it. It's definitely a little bit higher risk now as compared to buying it coming out right here. But you have a nice tradable area. Let's just measure this. 7%. Yeah, so you could even put on, say, a half position today, put a little stop here at 1050, and hopefully it'll just build out, continue sliding sideways, and then maybe break out on earnings in 10 days. I don't buy, as you know, if I don't have a 5% cushion going into earnings, and I drastically reduce or cut the position because I don't want to be have money bet on a coin flip, so to speak. HWM, another great looking chart. I hope you're already in this one. This is wedging up a bit. I certainly would not buy this right now. I'd want to see it slide sideways and even droop down a little bit and build. This is really short consolidation zone. I'd like to see that build out farther. IOT, I like this one better. You've got a nice prior uptrend. You've got a 2-month long base at this point. Got good support off the 50-day. I personally would have been comfortable putting on part of my position right here on Friday. It's running into some supply. Let's see it tighten up and then push through 29. Then I would add another piece of the position. 5 to 8% stop. And looking at it on MarketSmith, this is actually becoming more appealing to me. Computer software, it's certainly been a hot industry, and you've got a really nice, it's a recent IPO, really nice atom and atom double bottom with a handle right here, and then a high handle right at the all-time high. So if it can just build out this handle a little bit longer and go, it will be not have any former supply to deal with. So yeah, I like this one. And then lastly, Rhombus, I believe earnings are coming out. Is it today? Yeah, after close today. Nice prior uptrend, and it's really making a nice base here. Got support around the 50-day. This stock, as you can see, has a history of getting support around the 50-day, not on the 50-day. So I would not, personally, if you're not in it, I never buy right before earnings. But if it can open quietly and then start pushing through this supply, there seems to be some supply coming to market here at 64. That'd be a great spot to put on half a position. Put your stop down here, and then maybe it'll build out a little handle and go. Semiconductor industry, this is a really hot industry right now. Let's see, Leanne, when trimming a position to capture gains, if you have multiple buy points, which method do you use when selling? First in, first out, or last in, first out? So in general, when I'm taking gains, I will sell, I'll do first in, first out, and ideally, although not as often for me because I generally swing trade, but ideally, if you sell the shares that you bought first, some of them you will have held for over a year, and then you will only be paying the long-term capital gains instead of short-term, which is considerably less. So yeah, first in, first out. And yeah, it's the same for me when trimming losses. And then the last thing I want to talk about, Matt Martin, we had kind of a lengthy conversation about relative strength. And I just want to show you the relative strength tools on MarketSmith. And you can find relative strength on other software platforms as well. It's probably the most important indicator if you think about it. You want the stocks that are performing strongest in relation to the indexes and in relation to all the other stocks in the stock universe. You want the leaders, right? So, in fact, if you just screen for stocks with a relative strength of above 88, That's going to find you a bunch of strong stocks, and most of them are going to have strong fundamentals. That's why they're doing so well. In fact, Mark Minervini suggests if you're a newbie, then just look at stocks that have a relative strength of 95 or higher, and ignore the 9,000, 800 other ones that don't meet the bill. Now, if you are fortunate enough to subscribe to MarketSmith like I am, it gives you the relative strength in two ways. One, it gives you a rating. Here's the RS rating of 99. That means that, in this case, Supermicro Computer, SMCI, is outperforming 99% of the stocks on MarketSmith, and I think that's like 9,500 stocks. In addition, it gives you the relative strength in terms of a line, and this is its strength. The line is its strength in relation to the S&P 500. So you want to see the stock near all-time highs, and you want to see the relative strength making new all-time highs. Now, Supermicro is extended. If we look at something that's not so extended, Rhombus, relative strength of 97, and it is just sliding sideways with the S&P 500 here, and we want to see it break out in price. We want to see the relative strength to break out. We want the best stocks in general lead the market. They're leaders. Looking at the one-year chart of Supermicro, here we see the stock breaking out in price right here in May of 2023. And we also see the relative strength making a new high. See how the general market, the S&P 500, is still sliding sideways, but the relative strength is making a new high. That signals strength, and sure enough, it in short order went from 120 to 326. I got to wrap it up. Thanks for all of your questions, Patreon members. If you want me to answer your question, consider joining my Patreon. Link in the description, in the comments section. If you guys have any comments or follow-up questions, just let me know in the comments section below. And Patreon members, I'll be putting out my next video of my portfolio and focus list this weekend, Friday or Saturday, I suspect. Take care, everybody.